Hello and welcome to this latest weekly market recap for the week ending Friday, March 13th, 2026. I'm Tom Bowley, Chief Market Strategist at Earningsbeats.com. It's a pleasure to be with all of you again this week. Not so much pleasure to tell you what happened last week because it wasn't very good. We saw volatility continuing to move higher, crude oil prices rising with all the geopolitical tensions coming out of the Middle East with, of course, the ongoing war between the U.S. and Iran. Continuing to see a lot of rotation in the market, a lot of whipsaw action. S&P 500 has moved below, is now down more than 5% from its all-time high. The Nasdaq has moved down more than 8% from its all-time high. So a couple of things we talked about at the beginning of the year at Market Vision 2026. One of the things I was looking for was a potential correction. The S&P 500 more than halfway there, and Nasdaq almost there already. We continue to see weakness in many of the growth areas and starting to see a little bit more deterioration in some of the growth areas that have held up well, including semiconductors. But overall, just another bad week. We're seeing some rotation that's starting to point a little bit towards a possible recession. I mean, just the way the charts are setting up, and I can go over some of those with you in just a little bit. I don't know that we're going to have a recession, but it is interesting to see the way the market's been trading lately. And we did get a GDP report on Friday that showed that the U.S. economy was growing at a much slower rate than expected, only 0.7%. And with sticky inflation, we got a lot of folks now talking about stagflation. Again, I don't think any of these things are going to stick long term, but any kind of fear, and this is the environment that we're in right now with a volatility index elevated up into the 20s. Market does not handle bad news well. It doesn't like uncertainty, and we got a bunch of both. So right now, the market, we're just trying to hang in there, maybe turn at some key support levels, but got to be really careful with where the market sits. Let's take a look at what happened this past week. Nasdaq 100 led the action, so at least that part of it was good. Nasdaq dropping last week only 1%, whereas transports, you can see on the other end of the spectrum, dropping another 4%. And this is part of the problems I have thinking about the economy and the possibility of a recession. Transports just 3-4 weeks ago looked great. They were rising. They were leading the market to the upside. Everything looked pretty good. It seems like maybe this war is starting to make a lot of investors think differently about where we could be later this year, especially in terms of our economy. I saw Meta platforms said that they might be laying off thousands of workers as a result of AI. So got a lot of things that the market's trying to digest right now, and I don't think that's usually a recipe for higher prices. But looking at the across the board, you can see Nasdaq best performer losing 1%. We had the S&P down 1.6, Russell 2000 1.7, the Dow Jones down 2%, S&P mid cap just slightly more than 2%. There were your transports down almost 4%. So rough week for the transports. Moving on to the sectors, we had energy gaining 2%. Clearly the leader. I'll show you a chart on the crude oil prices, but crude oil prices continuing to trend higher. That certainly is elevating many of the energy names. Utilities, talked about this one, talked about it in our seasonality report. I've been writing about this group, utilities. It tends to outperform the S&P 500. And considering that during this secular bull market, which began back in 2013, utilities have outperformed the S&P 500 every year since 2013, except for one. So this is a really strong group, or at least it's a group that tends to outperform during March. March can be a trying month. A lot of money rotates into the utilities. Also, another thing that might be factoring in is, and so far, by the way, so far in March, utilities have underperformed the S&P slightly, or maybe it's pretty close. I'm not sure where we ended exactly on Friday. But one thing that could be playing a little bit of a role in keeping utilities from doing even better is the fact that the 10-year Treasury yield has actually been moving back up. So as that yield moves back up, income-oriented investors would tend to go with something a little bit safer in terms of the 10-year treasury, as opposed to utility stocks, which can fluctuate. The value of the individual companies can fluctuate. So that might be, maybe taking a little bit of a toll on utilities on a relative basis. But if we see that 10-year treasury yield start to move back down, I would suspect utilities are going to do really well the balance of the month, but we'll see. Technology outperforming most areas of the market last week, outperforming the S&P 500. So it wasn't all bad news last week, even though we did see all of our major indices moving lower. Technology outperformed on a relative basis. And that is usually a good thing from a longer term perspective if that continues. And then everything else was down more than 1%, starting with consumer staples and then ending with the three groups that were down more than 3% last week: financials, consumer discretionary, and industrials. And you'll find a lot of cyclical areas in those three sectors. And again, that's a part of the problem, I think, with the market right now, is it seems like a lot of the cyclicals starting to take a bigger hit. And that could be as a result, again, of folks believing that with the war, the lower GDP that came in, that maybe, just maybe, we could have a recession, mild one, later this year. I'm not in that camp just yet. I do think the threat of a recession could definitely play a role. I just don't know that we're going to see a recession. Moving on, let's take a look at the S&P 500 against all of those sustainability ratios that I like to follow. S&P, you can see really starting to roll over a little bit more, gaining a little bit of steam to the downside, and that's never good with the volatility index up in the mid-20s, which I'll show you a chart on that in just a minute. But you can see March has started to roll over. Doesn't look very good. We're getting a lot of gap downs and not a lot of selling late in the day. But Thursday and Friday, it's worth pointing out that we did close almost right on the lows of the day, both days. So we're starting maybe to see a little bit more selling in the afternoons. And I think if we get that again starting this week with the volatility index continuing to move up, we could start to see selling accelerate. The QQQ versus the S&P 500, or the spider, you can see that had been moving up. We saw a little bit of a pullback late last week, but some of these others are even more damaging, in my opinion. One, discretionary, which I just showed you, was down more than 3%. When you compare discretionary and staple stocks, discretionary started to roll over again. And this is an index that kind of points to a possible recession. Anytime staples are outperforming discretionary, you have to wonder maybe if something's coming down the road that's not very good. And we've been seeing this move to the downside for a little bit now, throughout the majority of 2026. And after a little bit of a bounce to start March, we've now started to roll back over again. So not a great look there. Another large cap, a large cap growth versus large cap value index or ratio is the IWF versus the IWD. And that had started to bounce a little bit. And now that rolled over late last week. So again, it looked like value starting to pick up on a relative basis. Another large cap growth versus large cap value. This is the Dow Jones U.S. Large Cap Growth Index versus the Dow Jones U.S. Large Cap Value Index. This too rolled over most of last week. So started to give away some of the gains that it had seen, relative gains that it had seen earlier in March. Mid-cap growth versus mid-cap value. You can see again, rolling over most of last week. Small cap growth versus small cap value is still the best among all of these ratios we're watching. And small cap, even though small cap's been doing poorly, it's still kind of holding its own on an intraday basis relative to the QQQ and the spider. That's a chart that I provide our members in our weekly market report every week. So definitely take a look at that again this week. I haven't finished all the relative ratios for last week, but I know it was holding up through the middle part of the week. And we'll see whether or not we continue to see some of that strength later in the week. But overall, all of the major indices have definitely rolled over. It's just a matter of, depending on how they line up with one another, the intermarket relationships, a lot of times they give us signals that the overall prices don't. You just see a downtrend. So you do want to pay attention to how all of the markets are performing relative to one another. Crude oil prices. So this has been a big issue for the market and continues to be. You can see since the Iran conflict really escalated, and the war began with the bombing in Iran, you could see the crude oil prices absolutely skyrocketing. So at the end of February, we were at $67 a barrel. On we closed on Friday at 99. Now we did have back on Monday. Remember, we went up to almost $120 a barrel, but that was an overnight thing. It was kind of a knee reaction, just a reflex to what went on over the weekend. So we had this big move up to 120, but we closed back down around $94, $95 a barrel, if you recall. And then we settled back down in the low to mid 80s. And now we rallied back and actually closed on Friday at the highest close that we've seen of 99. So we're right on the cusp of closing above $100, and things are intensifying in the Middle East over the weekend. It's going to be very interesting to see how the market opens on Monday, but market doesn't like bad news, especially when the volatility is way up, and that's certainly what we have right now. All right, volatility index. You can see the volatility index just continuing to steadily move higher. So again, back on Monday when we had crude oil prices jumping to almost $120 a barrel, we saw the volatility index spike. I never saw 35, but I did see on Monday morning we were up around 31, 32 on the VIX. Settled back down into the low 20s. Market kind of, settled down a little bit after that initial selling on Monday. But by the end of the week, things were escalating again, and volatility index was back on the move to the upside. And one of the things that I say in the market about the market is that not many things good happen when the volatility index is above 20 and rising. And if you look at where we are right now, we're above 20. And throughout the week last week, except for the one little jump on Monday and a quick little pullback, we've been rising. We continue to see fear building in this market. And when you get fear building, what that's telling you, what the volatility index tells us, is that market makers are pricing, all these securities, well, specifically the S&P options, with a lot more premium. So anybody willing or wanting to trade options has to pay more for them. And the reason you would pay more for them is because you believe that the volatility is going to be so great that it's worth paying that extra premium because of these huge moves to the upside and downside. And it protects market makers by giving them more money for having to commit to taking the other side of the trade, if you will. Now, there are ways that market makers can protect themselves. They can still trade the underlying stock along with taking on, providing liquidity in the options market. So don't feel bad. They're not going to lose money. They're going to continue to make money, and they can make a lot more money in a volatile environment because these premiums are so high. I know a lot of options traders, love this market that's crazy back and forth. But when you're paying these kinds of premiums, I hope you get the direction right. Because if you're wrong, if you think the market's going to go down and it reverses back to the upside, you're going to lose a lot of money in options. Same holds true if you go the other way. So just please be careful out there. This is a very difficult environment, one that can change very quickly in terms of price action in our major indices. And so I prefer to sit it out. That's usually my thing, is when when the volatility index is above 20 and rising, I tend to be on the sidelines. I might try to trade a little bit here or there intraday, but I don't know what we're going to wake up to the next morning. And so holding stocks overnight, to me, it's like you're just taking your whole portfolio and just putting it on red or black in Vegas, because you don't know what you're going to wake up to. Any kind of good news that comes out that, hey, Iran's willing to maybe sit down and negotiate, anything like that, market would skyrocket. And we would see the VIX take a big hit to the downside. But if Iran digs in their heels and they start attacking their neighbors, continue to attack their neighbors, there is likely to be more volatility and more market weakness ahead. And it can escalate quickly, so be careful. All right, a few things I wanted to go over. I talked about the possibility of a recession. building. The first thing you can look at is anytime discretionary is underperforming staples. And that's what this chart's telling us. It's a ratio chart. It's the XLY divided by the XLP. So when discretionary is outperforming, this line goes up. When staples are outperforming, this line goes down. So when it's going up, it's telling you that market participants are willing to take on more risk. It's a risk-on kind of an environment, and that normally coincides with strong stock markets. When it's going down, it's a risk-off type of market environment where money is rotating more towards value or defense, and that is usually associated with a much more challenging market, either a very volatile market that's kind of going up and down, but not really making up its mind as fears building, or one in which the market's simply going lower. And that kind of is what we look like we're doing now, starting to roll over and trend down. And so this is never a good thing when you're seeing this ratio moving to the downside. It's one of my favorite intermarket relationships. I've said that over and over again. Knowing what's going on in the consumer area, keep in mind, consumer spending is roughly 2/3 of our GDP. So when the market is telling you which area of the consumer stocks to be in, that's giving you a decent sign of what Wall Street is expecting down the road. And when this is going down, it's usually not because of great expectations. It's because of a challenging market ahead, which is what we talked about 2-3 months ago. I started talking about this in December. Didn't know what the news stories were going to be. Never do. When you start seeing the charts and they just give you warning signs, it doesn't come with a handbook explaining what issues we're going to face. I mean, there's some that probably are back saying, well, if you had known that, you got lucky because the war broke out. Hey, I didn't know what was going to break out. I didn't know I didn't know if it was going to be a recession. I didn't know if it was going to be inflation. I didn't know if it was going to be the Fed. I didn't know what it was going to be. I just knew the market was starting to send signs that usually precede a challenging market environment. That's what we saw at the end of 2025. And now this is what we're getting. Transportation stocks. So transportation stocks, like I said, started out the year really strong. And when the market, was kind of weakening a little bit, and I saw transports going up, I was like, well, that certainly is going to help, in my opinion, limit the downside in the market, because transports only go up for one reason. And that's because Wall Street is seeing a better market environment down the road. Well, if you look at what's happened since this war broke out, all of a sudden, transports have lost their luster. And we have now been going down for the most part for about 7-8 days in a row. I mean, a little bit of bounce here or there. Look at the relative weakness that's come in. I don't know where we go from here. It would be bullish for the market if this relative line starts to turn back up. If we keep going down, it's not going to be a good sign, not with everything else that's going on in the market. Banks were fine until second week of February. And then banks started moving down. And here in March, you can see we've now broken to a 11-month relative low, banks versus the S&P 500. Banks don't need to be leaders for us to feel good about the market, but banks need to be going along for the ride. Banks need to be doing, pretty well, just okay. And right now they're not doing okay. They're rolling over and they're underperforming the market. Home builders. Again, home builders were starting to show strength in February. We had moved to about a 5-6 month relative high on the Dow Jones U.S. Home Construction Index relative to the S&P 500. And literally over the last 4 weeks, straight down. Not good. For those of you that are new to Earningsbeats.com, a couple things. First, go to our website, Earningsbeats.com. Both words are plural, Earningsbeats.com. Start your no-cost trial. We have a free 30-day trial. You do have to provide a credit card, but we'll let you know before it expires, before your 30 days expire, so you can decide if you want to continue with the service or not. And if you do, we'll give you a great annual offer. And by the way, 95% of our members are annual members, maybe more than that. Also, we have a free newsletter. So if you just want to learn more about us and follow how we follow the market, sign up here. Normally, the EB Digest comes out 2 days a week, Mondays and Wednesdays. Usually comes out Mondays, could be Wednesday or Thursday. Just depends on how the week's going and so forth. But Monday, Wednesday is probably the normally when we do send this out. And it's, when I say newsletter, it's a chart in 2 paragraphs. It'll take all of 3 or 4 minutes for you to go through. It could be a trading candidate, just talking about relative strength, gaps from earnings, sentiment. It could be any number of things that we talk about. But check that out. Literally tens of thousands of folks have joined us on the EB Digest. So you certainly would have a pretty big crew. And the reason there's so many people on it and have subscribed is because we provide some value. This is not just a, something you're just going to toss in the trash can. I think it's something you're going to enjoy. So make sure you check that out. Not quite ready to announce it, but we are going to be having an event coming up, probably in about a week and a half. And you're going to want to be part of that. So signing up for the EB Digest also will get you set up to join us for this free event coming up. It's going to be certainly a valuable event. Also, a couple other things real quick. That like button, hit that like button for us, please. That really helps us on YouTube. Also, subscribe to our channel. We do free events from time to time. And if you're subscribed to our YouTube channel and you turn your notifications on, if we start a free event, you'll be notified. So it's definitely a win-win. Make sure you do that. That helps us, supports us at Earningsbeats and our mission to provide quality information to a lot of folks out there. All right, last thing I want to do is just go over real quick this short squeeze chart list. This is one of the chart lists that we do for our members. Update it sometimes twice a month, sometimes once a month. It's been about a month, so we'll be updating this again soon. Doesn't really change a whole lot from month to month. But what we do is we provide, if I put this in order of numbers, we provide the highest level of short interest for the stock. So we go all the way down to 20%. So any stock that has a short percentage of 20% or more, they would be added or a part of this list. And then we just keep track of it, because when stocks break out and they have a lot of short interest, it forces a lot of shorts to cover. So it gives you extra volume on the buy side, which can send stocks absolutely screaming higher. So if you look, for instance, last week, HIMS was the best performer, and in 1 week it gained 57%. 35.7% of its float is short. The float is the amount of shares that are available to trade out there. 35% people had borrowed those shares and sold them. So if at some point those folks have to come back and buy, that's the beauty of a short squeeze, is whoever has borrowed shares and sold them must return those shares to whoever they borrowed them from. So they've got to buy shares back at some point. And when stocks start to move up and you get a stock that's heavily shorted and you get all these buyers panicking because they've got to cover and pay off that borrowing, as prices go up and up and up, they're just losing more and more money. Their losses are unlimited. So when you look at a chart like HIMS, you can see, look at the volume explode on this gap up. So all these shorts loving life, but anybody who shorted this stock down around $14, $15, $16 is not loving life this week, not after the stock jumped to $25. So their borrowing just continues, their liability continues to go up as HIMS moves to the upside. So anyway, that's just a specialty chart list. I wanted to kind of show you. Now, one thing I do not like about this particular chart is the AD line keeps going down. So I think eventually HIMS rolls over and goes back down again. But some others, I wanted to point out, NVTS, this one, the AD line's actually going up, and the stock's been holding on to pretty good support. I think if this breaks out about 11.5, I think this one could really run maybe toward that 17 level again. And it could happen in a day or two. So this is one to keep an eye on. I don't like buying these stocks in pullbacks because they may never go back up again. I like buying these stocks when they're breaking out, when they're hot. That's when you want to buy these stocks, but they are very aggressive, very risky. So please be careful. Anyhow, that's all I have for you today. I appreciate you, and I hope you have a great rest of your weekend. Let's see what happens this week in the market. Please, again, please, please, please be careful out there. Market is set up with a volatility index in the 20s and rising to potentially go lower here, and it could be quickly. So just be careful and on your toes. Have a great rest of your weekend and upcoming week, and I'll see you next weekend. Happy trading.